Hey guys, it's Elizabeth Rose, and it's Friday afternoon, and it has been an incredibly volatile week in the mortgage market. And it seems to be this is the new norm. So gone are the days of just kind of an easygoing up and down motion of the market. Now it's just like absolutely crazy. You may have heard that rates have been rising, and I wanted to share with you a little bit of what's going on. Today we finished the day ending down 40 basis points. And when I say down, that's not down like lower interest rates. It actually has the inverse reaction when the market's down. So when the market's down, interest rates are up. And the market this week finished today alone 40 basis points down. I'm going to take you in a minute and show you a graph so you can see what's been going on. But when we look back to where we've been, and we started this year knowing that interest rates were going to be on the rise, we've been watching and waiting to hear what the Fed has had to say about hiking their short-term interest rates, which has not yet happened. And we've been watching inflation. But we've had another little thing thrown into the mix, something that's, from another planet, you might say. Over in Greece, there have been talks of a bailout. And all of this conversation that's taking place across the pond is putting a lot of pressure on our bond market. Stocks have been doing so much better in light of the news and the pending negotiations or conversations. Tomorrow there's a big meeting about the Greece bailout, and a decision is expected. In fact, we really thought that it would come today. It didn't. So we're looking for it to come Monday, and the markets have already prepared for it. The bond market just looks crummy. There's just no other way to slice it and dice it. So with a crummy looking bond market, that is where our interest rates come from. They come from mortgage-backed securities. And so with those securities being somewhat in the toilet, you could say, we've seen some upward pressure on interest rates. And now we are over the hump of the 4% handle. So if you are out there shopping for a home, you've been pre-qualified in the threes, you might want to reach back and double check your figures and make sure you're still good to go for that certain price range with the rise that we've seen in interest rates. But let's take a look real quick. And let me show you what I'm talking about here. Bear with me while I make a little switch here. All right, there you're looking at the mortgage-backed securities. And over here in the left-hand column where you can see my little handset signal, that is the beginning of this year. And if you can see, let me see if I can drag this chart over a little bit. Here we go. You can see we have come quite a ways down, and here we are today. You see this red candle here at the very end. It just stinks. We have fallen from, we've fallen over 200 basis points just in the matter of about 30 days or so. 200 basis points in mortgage-backed securities translates to 0.5% in interest rates. So if you were looking at something around 3 7/8, 3 3/4, somewhere in there, you're now looking at 4 1/4, 4 3/8, 4 1/4. You're going to be in that range somewhere. So I strongly advise you, if you've already been pre-qualified and you have one of those beautiful rates in the threes, and you are still looking for a home and have not made an offer yet, and you're not locked in on a rate, it's really prudent for you to get back and make sure that you are still going to be okay when the time comes to write a contract, because you don't want to fall in love with a house and then find out that you just don't quite qualify for it anymore. So anyway, with that, I wanted to just let you know what's going on, what I'm seeing. And honestly, I get asked an awful lot where I see interest rates going over time, over the rest of this year, the rest of the summer even, just in that short time frame. And honestly, every major forecaster out there has said we're going to see an increase in interest rates. We are already seeing it. And now every day, intraday, and certainly looking at just a week's picture, we are seeing a lot of volatility. Some days we will get some improvements. We'll see a little bonus. And other days we're going to see some increase. Overall, though, the trend is that rates are moving higher, and there's just no other way to slice it or dice it. That is what it is. So where will they be at the end of the year? Nobody really knows. The Fannie Mae, Freddie Mac, a lot of the forecasters have predicted that they would be in the high 4s to maybe knocking on 5. I don't really see that. But then again, I don't have a crystal ball. Neither do they. Anyway, that's where we are as we finish out this last full week in June. Remember, next week's a holiday week, and so most offices will be closed next Friday for the July 4th holiday. What that means is we will have a shorter trading week in the bond market. A lot of times with holidays, we'll see an exit of all the traders. They're heading off to who knows where, Kennebunkport or wherever they go up there to the shore. And so with lighter trading activity, things can be exacerbated, and so we could see increase in volatility, or we could quite frankly see it just flatten out. So next week will be an interesting week, but this week we are finishing quite a bit lower than where we started the week, and once again, I'm just going to pester you. If you've already been pre-approved and you've been pre-approved at an interest rate below 4%, I highly urge you to go get your numbers checked and make sure you are still good to go for that price point that you had previously been approved for. And with that, I'm going to sign off. Wish you a wonderful weekend and enjoy this fabulous sunshine that we finally have here in Texas. Have a great week, everyone.